Do you know why Netflix is worth $300 billion? It's not because they make great shows. It's because 260 million people pay them every single month, whether they watch or not. That's what's called recurring revenue. That's subscription-based services. And private equity firms and investors are obsessed with it. Right now, they're buying up trade businesses using the exact same playbook. They're looking for HVAC companies, plumbing shops, roofing contractors that have customers paying them every single month, just like Netflix. My name is Vince Perry. I'm a business broker, and here is what I see. Investors will pay 4x to 6x EBITDA for a business with recurring subscription revenue. The ones without it, 2x, 3x. Same industry, same revenue, but one business is worth double, sometimes triple, because it's built like Netflix. Here's the thing. Your customers already understand subscriptions. They pay for Netflix, they pay for Amazon Prime and Spotify. And if you're not offering them a subscription to your service, private equity sees you as risky. In this video, I'm going to give you 3 proven models, the exact script that gets customers to say yes, and the tech to automate all of it. By the end of this video, you'll be able to add recurring revenue to your business today. But first, you need to understand why recurring revenue is the difference between a 2x exit and a 6x exit. According to industry M&A data from firms like Capstone Partners and Axial, there's a massive gap in how private equity and investors value your company. Project-based businesses, if you just have a customer list of one-off jobs, you'll typically sell for 2x to 3x of your earnings. Recurring revenue businesses, if you have contracts, maintenance plans, subscriptions, that multiple jumps to 4x to 6x. Top-tier platform companies are trading for 8 to 10x. Let me say that again. $1 of recurring revenue is worth 300% more to your net worth than $1 of one-time revenue. Here's the issue. You sell a $10,000 HVAC install, collect the check, and then you're back to zero. Every month, you're hunting for the next sale. That's exhausting, and investors see that again as risky. But recurring revenue, that's predictable. Private equity and investors, they pay a premium for predictability. By the way, this also kills seasonality. Recurring revenue covers your overhead, your rent, truck payments, insurance during slow months. Imagine waking up on the first of the month with $10,000 already deposited into your bank account before you've done a single job. That's the Netflix model for trade businesses. So, how do you actually build this? There are 3 proven models, and one of them fits your trade perfectly. Model number 1, the maintenance model. It's best for HVAC, plumbing, garage doors, roofing. The concept? Prevention. Expensive equipment breaks if it's not maintained. Industry pricing, anywhere from $14 to $24 per month. And here's what they get. 2 seasonal tune-ups per year, a 15% discount on all repairs. Priority status. When it's 100 degrees out and everyone's calling, your members skip the line. The business win, you fill your schedule during the slower seasons when the phone isn't ringing. Here's why private equity loves this. It's predictable. They can look at your 500 maintenance members and know exactly how much revenue is coming in next month, next quarter, and next year. HVAC companies with maintenance plans sell for 5 to 6x EBITDA. The ones without it, 2 to 3x. Model number 2, the subscription model. This is best for lawn care, pool service, pest control, cleaning. The concept here is automation. This is the closest thing to the Netflix model. Here's the strategy. You stop offering one-off services, or if you do, you just make them really expensive. If a one-off lawn cut is $85, but the weekly subscription brings the price down to $50 per visit, the customer feels like they're saving money, and you just lock them in to 52 weeks of consistent revenue. The business win? Route density. You minimize drive time and you maximize profit per man hour. Investors love subscription businesses because the churn rate is usually very low. And now model number 3, the retainer access model. This is best for like a handyman, electrical, general contractors. The concept here is peace of mind. Think of it like AAA for your home. So industry pricing, you're usually looking at like a $19 to $29 per month. And here's the deal that they get. 1 free annual safety inspection, waived dispatch fees. Value is $59 to $89 per visit. The business win is when a breaker trips or a faucet leaks, they call you immediately because the trip fee is free. You own the home. And here's why investors like this model. It's a high margin. You're collecting $19 to $29 per month, and most members won't even call you every month. That's pure profit. All right, you've got the models. Now, here's how to get the customers to actually sign up. There's one tactic that gets customers to say yes 80% of the time. Here's the script. You're at a customer's house for a repair. The dispatch fee is $89. And you say, Mrs. Jones, the dispatch fee today is $89. However, if you join our VIP plan for just $19 per month right now, I'll waive that $89 fee immediately. You save $70 today. And you get 15% off of the repair I'm about to do. That's it, guys. That's the script. The psychology is the dispatch fees are a grudge purchase. People hate paying them. By waiving it, you turn a negative into a positive. And here's what's happening on the back end. You just turned a one-time $89 transaction into a customer paying you $19 per month for the next 5 to 10 years. That's $1,140 to $2,280 in lifetime value from one conversation. The next tactic, the auto-renewal, is mandatory. The rule, never do invoice me later for memberships. It must be a credit card on file, auto-drafted every single month. Netflix doesn't send you an invoice every month. Neither should you. Low churn is what private equity is paying for. Last tactic, commission the techs. You're not at the kitchen table, your tech is. You need to motivate them. Industry standards, you pay about $15 to $25 cash for every membership that they sign up. The ROI math is simple. You pay $25 once, and the customer pays you $19 every month for the rest of the time they're a customer. In month 2, you've already made your money back. For the next 10 years, that customer is pure profit. Pay your techs, guys. It's the best marketing money you'll ever spend. Now, let's talk tech. You cannot track this on a spreadsheet. When private equity does due diligence on your business, they're going to ask you to see a CRM. If you say spreadsheet, the deal is dead. What you need, guys, is stored payment profiles, batch billing, membership tracking. So here's the tools to look at. Service Titan for big shops, $300 plus per month. House Call Pro, very popular, is $50 to $150 per month. Jobber, by the way, sponsor of our show, $30 to $100 per month. And if you click on the link below, you actually get a free 3 months just with our subscription. If you have 200 members at $19 per month, that's $3,800 per month in revenue. The software costs $100. Do the math. That's a 38x return. That's it. One-time customers become lifetime customers. Lifetime customers become predictable cash flow. Predictable cash flow becomes a sellable asset. That's the formula, guys. Imagine selling your business for 5x EBITDA instead of 2x EBITDA. That's an extra $500 to $1 million in your pocket. That's what recurring subscription revenue does. Now, if you want help implementing this into your business, if you want someone to walk you through building these models, training your techs, and setting up the systems, book a call with me. The link is in the description. Let's get your business ready for that premium exit whenever that may be. I want you to know which model fits your trade. So I want you to drop a comment below. Type maintenance or subscription or retainer, and I'll be sure to get back to you as soon as I can. That's what we got, guys. Make sure that you like, that you subscribe, and follow me on social media. See you next week. Peace out.